Morning, Oak Bloke here, and this is going to be my second crack at getting an article recorded about the works. I covered the works pretty much. Well, first time I looked at it even was when I wrote this article nearly a month ago, which was the Fun Run update. So, just to explain what a Fun Run update is, nothing to do with running. Well, it's running your share ideas. So this is based upon some of the people that I think are, the best, or the best minds of the stock market investing, and so you've got various different people in there. Anyway, the race leader in all of this was Mr. John, and his best idea was the works. So of course, why would you not look at the best idea from the best performer? You'd be a bit crazy not to. So I did. So in this part of the article here, and I'd sort of further point out that in this update from another writer called Cockney Rebel, Mr. Rebel had talked about the work, so I read through his article as well. So just kind of get to grips with, well, how on earth has this gone up by 175% in just 8 months or 7 months at the time. So very impressive. Anyway, I summarised the numbers based on Mr. Rebel's article and read through the RNS, did my own research, and arrived at whilst in the year to April 2025 they'd achieved a net profit of 3.8 million. There was a potential upside of 22.7, which would together add to 26.5, and that's pretty much the market cap. That is pretty much, well, in fact, that is the market cap if we go and look at this. 26.3. So it's, you can see it's come down in price since recent highs. So anyway, I kind of thought, well, great, that looks really good. So this is the basis then for my article, which is going to be released in the next couple of days to my Substack, which is theoakbloke.substack.com. And this article kind of starts with the premise of saying, whoops. And the reason I say whoops is that what I read when I read the Cockney Rebel article and read the RNS was, we remain on track to deliver sales in excess of 375 million and an EBITDA margin of at least 6%, full stop. But there wasn't a full stop. The actual sentence was this: we remain on track 6% within 5 years. 5 years, right? Okay. And slightly didn't panic, but because clearly they had performed well. But my next question to think was, well, okay, I've either got to be very patient for 5 years, or that 5-year increase, which, to be fair, if something is chucking off 27 million a year and its market cap is 27 million or 26 million, it's at one time its own earnings. For every pound you invest in, you get a pound back every year. Well, clearly the share price is too low. That's just common sense, hopefully, that you wouldn't expect 100% interest from a bank account, for example. Obviously, share investing is not the same as investing money in a bank. You do your own research and you make your own investment decisions, and clearly there are risks involved in investing in shares. But nevertheless, when you kind of look at things that are a potential vast discounts to their future potential, then, well, of course, yeah, great. Anyway, I guess, so my motivation was to say to myself, well, okay, I've made a mistake based on 5 years. Well, what's it going to do in 1 year? Because you're also interested in that, aren't you? You don't want to necessarily be hoping for something in 5 years' time. Sometimes you do, but I also wanted to know, well, what does 1 year's time look like? And also, apart from Mr. Rebel, I don't think anybody's ever covered this share, to my knowledge. I had a look round, couldn't really see any other analysis. So it was quite an interesting opportunity to put a second view out there to kind of come up with my own perspective. Anyway, didn't take me long. If I'd done my own research, done more research than I did, I would have found this statement, which is where the management say for FY26, we are expecting further profit growth. We're comfortable with external forecasts of an adjusted EBITDA of 11 million in FY26. Now, FY25, the EBITDA was 9.5, so we're talking about a 1.5 million increase, which on 9.5 million would be about 15, 16%. So I'm happy with that. I mean, obviously it hasn't happened yet, but let's kind of get into why I think it will or could happen. See, none of this is advice. You make your own investment decisions. By the way, the picture that I've put on this article is not a real picture. It's just what I would do if I had a company like this. I'd put a great huge whacking W, so it had very, very, very clear branding, which kind of reminded me of Woolworths from years ago. Anyway, little bit of just a little bit of fun there. The history, and my own history, I guess you could say, with the works was that I mean, I don't go shopping that often or that much. Particularly, I'm not a retail therapist, but I'd always pop into the works. There would always be like esoteric books in there, and I would buy a book on who knows what. Um, you know, the finer workings of enameled mugs, or who knows what I would buy. But they always had very esoteric books in there at silly prices. Very different to Amazon, where you could just get any and every book under the sun, delivered the next day kind of thing from wherever in the world. So not the same proposition. It was kind of what in my article I kind of say kind of was almost like the middle of the middle of Lidl, as it's come to be called in a certain supermarket. Not sure which one, but yeah, it's that sort of bargain basement. Go in and find something at and it's that fun of shopping in a place that now. I mean, maybe I'm wrong, but I think that esoteric kind of let's put all these wacky books and see if a wacky guy wanders in and buys, and I think those days are a little bit gone. Which probably is not a bad thing, because there's not that many people that are into books on enameled mugs or whatever mad books there were. Um, but I mean, just being a bit more sensible, because I'm not interested in enameled mugs. Don't send me any books on that, please, or any articles. Not interested. But just things like, I don't know, the full edition of Game of Thrones. I remember sort of like, oh yeah, there it is on Amazon. And I wandered past the works, and it caught my eye in the window. Oh yeah, they've got it at. I can't remember how much I paid now, but it was like a thing of books like this wide in cellophane for about, I don't know, 25 quid maybe for 8 books, 7 books. I can't remember how many books. A lot of books that wide, which took me a long time to read. That was good value. But anyway, that's that's by the by as well. Um, and yeah, so anyway, that's the background. I mean, so what I'm probably trying to say is that they compete against supermarkets, the middle of different supermarkets and all of that. They compete with other high street shops, a wide range of high street shops across books, stationery, um, uh, um, crafts, and so on. So I'm going to zoom this in a little bit. So sorry, and toys, of course, toys. So there's so I would argue that today's works is far more kid orientated. I mean, it always was. There was always kid stuff in there, but I think today it's very much aimed at kids, and then the parents of kids, which is fine. That's and it's all about sort of, as it says here, being specialist, being discount, and yeah, just doing something different from the many competitors out there. And this is their website, so you sort of see, there's packs, 3 for 7.50, and book of the week, and new arrivals, and special editions, special offers. There's loads of special, like, still they've got things like, oh, the RRP is £10 and we're selling it at £3 or £4. So there's still plenty of that bargain basement to it, but I guess it's sort of positioned a little bit more towards, you know, the kids that walking by, oh, let's go in the works, let's kind of it's that nag, what I call the nag factor. And I like buying shares where there's a nag factor, because I know the nag factor is pretty much guaranteed. uh, and the other thing I'd say is that it's very much around kind of getting kids away from screens. And I tell a little story quickly. On my last holiday, I was in this large sort of outdoor dining area of the hotel, lovely hotel. And there was one family where they were actually talking to one another, the parents and the children, and pretty much every other table there was a screen and a kid. And the kid was nom nom their food while staring at a screen. No conversation, just screens and kids. Now, in my own experience, I think whilst that's dreadfully sad and blah blah blah, um, I think even if parents give screens to kids to shut them up, it's also true that parents are worried about the amount of screen time that their kids have, and therefore worried that they should have interests beyond staring at a screen all day. It's sort of that's where the works come in. They're very much around, let's get kids playing games, let's get them playing board games, let's get them playing outdoor games, let's get them crafting, let's get them doing all, let's get them reading books, for goodness sake. I mean, you want your kid to be successful in the world, and reading on a screen, reading words on a screen is not the same as reading. Your brain doesn't work the same way when you read on a screen versus read a book. Your brain processes the information differently. So, you are your kids are missing out. Your kids are being disadvantaged if you don't do these things, essentially. So that's why the works is well positioned to profit from a genuine concern from responsible parents, let's say it that way. So anyway, that's just my opinion. That's my basis, my thesis. um, the works have done a lot to kind of tap into the here we go, my poltergeist is back. I will try and get my poltergeist to stop scrolling at my oh, I think what I did last time was I just told it to, oh no. This annoys me when this happens, but I did find a way to, oh, there we go, it's stopped. Let me see if I can get it to give up the ghost. Yeah, I don't know what causes this to, see, I just lost control of my mouse as well. Oh, there we go. Yep, we've regained control. Poltergeist has been ghost busted. Anyway, let's try and move through this article. So, um, yeah, yeah, tapping into sort of big stories, Peppa Pig, Bluey, Night Guard, and all of those. Uh, a lot of the social media is based around driving people through competitions, win a prize, win a day out at the zoo, win £100 of vouchers, all of that sort of thing. And the online reviews, they were into their hundreds, not millions or anything, but I'd say about half were positive. basically you've got a lot of people out there that like the works, that are positive about the works. The 50% that were unhappy, basically it had a bad experience with delivery. It was almost 100% of the reviews, 100% of the negative reviews were people unhappy with delivery. There's one or two like ex-employees unhappy that you know works and nasty people, blah blah blah. Which, by the way, I mean, I've never worked for the works. I'm not associated to this company or any company that I talk about on these videos. But from what I see of their job descriptions, they're very fluffy and very um, employee friendly. I think they kind of have a they appear to have a nice inverted commas culture. Job adverts full of emoticons, for example. So very very modern, very Gen Z type approach. I mean, I've never seen a job. Not that I particularly look at job adverts, but in my research on this company, I kind of went and looked at the careers pages to kind of get a sense for them. And I've never seen job adverts full of emoticons like rainbows and little smiley faces and all of that stuff. So make of that what you will. 307,000 Facebook followers, which is 4 times that of W. Smith, more than Toys R Us, about the same as Hobbycraft, but much less than Smith Toys. So I wouldn't say their social is um, market leading, but it's certainly well above quite a few of its competitors. Obviously, I didn't bother comparing to the supermarkets because, of course, they're going to have millions and millions, but who cares? I think they are working on things like a time well spent strategy. I couldn't see any evidence of that succeeding particularly. They are also sort of doing very much sort of trying to tap into events, which I think is a great idea. In fact, I don't think anybody else is doing that, which is like, oh, let's get a Iggle Piggle Night Garden character to come to the shop and wander around doing his Iggle Piggle squeaky thing. And kids love that stuff. They'll go along to an event at the works, and like maybe some sort of face painting day. You can just imagine, can't you? I mean, once you get going with that sort of thing, you could sort of turn that into quite a strong event-based approach that can help drive sales and drive loyalty, drive stickiness to your brand. And what they seem to do is a lot of kind of social media posts from like shopping centres, which I mean, maybe it is the shopping centres, or maybe it's just some um, different social media accounts that have been set up. So, if you're from Trumpton, there's a sort of a social media feed called Trumpton Shopping Centre where they talk about the works. So I suspect that that's what those are. That Yeah, they're just there to kind of bang out social media messages. So 5-year plan, as I say, my initial article was based upon what they're planning over 5 years so in 5 years' time, they would be at a future potential 1 times earnings. Um, the EBITDA in the last financial year up to April was 9.5. So the increase would be about a sort of quadrupling, a quadrupling of EBITDA, which would probably translate to around today's market cap. And so I mean, I'm just sort of referencing that I covered in the other article. So elevating the works is how they're going to get there. So this is the plan, that they want to grow margin, they want to grow sales, they want to become the favorite destination for affordable screen-free activities for the whole family. So a nice, clear strategy. They've made good progress. So in the last year, they increased margin by 2.1%, or if you ignore the foreign currency, because really you can't do a lot about that, then it was 1.7. So you can sort of decide which number of you want to use. 2.1 is obviously the headline difference there in margin. Of course, there's been further weakening of the US dollar since April. So, if anything, there'll be a even stronger FX effect potentially in the current year, depending on where the dollar goes from here. But obviously, currently it's heading weaker, sort of about 136 at the moment. So, I think probably about 3 or 4% weaker still than so zero point 0.4 is obviously quite a small movement. Um, so they're planning to. This is their strategy. New some optimization of the portfolio, new sales, increase of margin, reduction in cost, and increases in price. So pulling all the levers essentially. This is a very interesting statement they made as well, which I picked up on. They made a strong start. Like for likes are over 5% ahead in the first 11 weeks to the middle of July. Now, what I'm going to do is now just cover the history or the last 5 years of this share. So I've worked through 5 annual reports. So what you can see is profits back in COVID days were minus 2.3, and you can see down here that sales were well down and gross profit was well down. And this 17 million was money from the government from furlough, and so I mean we can almost sort of ignore 2021 because there was a lot of lockdowns that affected the works. Obviously, the works were not an essential shop. So I don't think they were open during COVID. In fact, I'm pretty certain they were closed because they say they were closed for long periods of time. FY22 obviously was the bounce back year, so a lot of the demand from 2021 got carried forward into post-lockdown 2022. So you can see here that the net profit was vastly higher in 2022, and then we can see since then statutory net profit has been growing, which on the face of it you'd think, oh goody goody, that's amazing, and that sort of then is confusing why the share would not be going up in price. But we also have to consider that there are extraordinary adjustments. So whilst the headline profit was that profits went up 1.7 million, there was then a series of adjustments. So these adjustments were so back here in 2021, the adjusted net profit was minus 0.8, so it was an underlying profit of 3.1. This one and so on. You can see it here. So actually, whilst yes, FY25 was a growing profit compared to 2024, it's probably fairer to say that 2024 was a very weak year on the face of these adjustments. And that the high point was here in 2022. And we are sort of at a quarter of the profits. Now, these are adjustments. So this is the underlying performance. But the next thing I'll say is that when you go back through 5 years of accounts, one of the things that you'll see time and again, almost every year, is that when they do their next year of financial accounts, they're actually revising the prior year of financial accounts. So here, when I'm looking at the 2021 annual accounts, and these are the numbers for 2021, if I fast forward to 2022, 2021 has changed. Okay, so they are essentially moving the numbers around, but these adjustments, obviously, there's reasons for the adjustments, and we'll come on to those in fact, let's look at them now. I went through all of the 5 years and worked out why were there adjustments, because adjustments are essentially extraordinary costs that you don't think are going to happen again, and because they're one-offs, whilst they have to be in the numbers, they are also they're also sort of treated as a separate line, so you can sort of see the underlying performance. Anyway, back in 2021, you had some one-off costs, and you had some impairments. You then had gains, which were reversing impairments. And reversing depreciation because the depreciation had been overstated. gains in 22, again, because of impairments that had been overstated. Uh, and then you've got, so in other words, the gains in 22, 23 weren't profits they made in that year. They were just sort of adjustments from prior years where they're having to kind of say, oh, actually, we got it wrong in the prior years. So you know, the adjustment is kind of, catching it back up, like the running total, if you think of it like a running total. But that adjustment doesn't exactly belong in that year because they haven't done anything in 2022 and 2023 to merit that increase of profit, if you follow me. What we then see is in 2024, um, we see then now a negative adjustment. So these are negative adjustments to cost of sales. Um, and this time again, it's adjustments. Partly they've written off their website is one thing, so they actually just completely write off the value of the website in 2024. They listed on AIM, on the AIM market, so they spent 500,000 doing that. They did a load of redundancies. They spent 0.7 million doing that, and then they had adjustments for leases. So a lot of the costs is leases, and those are treated in a particular way. 2025, you've got fulfillment costs. So this was where the online e-commerce provider let them down, and that led to exceptional fulfillment costs because they had to get somebody else in to clear the backlog. Restructuring costs, again, redundancies essentially. 2 million of cost of sale adjustments due to disposal impairments. So anyway, when I looked at these numbers, now this is the bit where I'm going to sort of veer from the standard accounts, is that, as I say, because a lot of these numbers belong not in the year that they're reported in, but they're having to sort of do that because that's accounting practice. In my opinion, and it is just my opinion, that these years are overstated by about 2 million, judging by the reversals that are happening later. So whilst the adjustments are happening in F24, 25, they don't belong in F4 25, 24, 25. They belong earlier in 22, 23. And then you've got the whole lockdown thing, and then you've got the revenge buying and the delayed gratification, which again I'm sort of estimating at about 6 million. Okay, and you can obviously say, "Oh no, that's nonsense, that's garbage," but I think those adjustments are actually fair enough. And what you then see, so these are adjustments to adjustments. What you then see is in 2021, the underlying performance of the business was that it was making about 3 million. The next year, I mean, yes, it was a bounce back, but it wasn't, because there was adjustments and other things going on. The business performance was 7.3. We then see the performance drop to 6.9. So what you can see is I'm deducting 2 million. I'm deducting here 8 million, which is 2 million from here and 6 million from there. Okay, and obviously adding 6 million here, um, to kind of provide a more balanced performance, and then adding back 2 million and 2 million here, which is basically just saying, like, yes, I can see that you've had to do adjustments to the underlying profit, but those belong in prior years, so I'm going to shift them to the right. So FY25. So what we see actually is that the FY25 performance is roughly the same as the 2022 2023 performance, and obviously a lot better than the 2024 performance. So to me, that gives me quite a strong view of the business is actually performing far better than you would imagine from looking at the share price. Um, and all of these adjustments are pretty much adjustments to cost of sale, is the other thing to say. So when they're impairing, they're actually sort of reducing or increasing the cost of sale in a financial year. So therefore, I mean, if we, you know, obviously it would make sense to show that as, rather than looking at net profit changes, let's look at cost of sale changes and gross profit. So again, these were the adjusted gross profit numbers based upon the adjusted cost of sale. But again, if I do my adjustments, my own adjustments, what we see is growing gross profit, and gross profit that's far higher than FY22. So again, the underlying performance of the business is that it's behaving and performing a lot better than 2022. Um, and 2022 was, if we go over a 5-year view, 2022 was back when this was at, 60, 70, 75p. Um, far higher, like almost double the share price of today. So, it was at a market cap of about 50 million pounds. What we see is that, well, based upon gross profit, well, there's not really a justification for it to be at half the price today. Okay, that's, for me, that's an encouraging sign. As I say, I'm making those adjustments based upon what I'm observing as where those adjustments belong, in my opinion. That's not statutory. That's my management accounts best estimates. Um, what I will also move on to now is like for like. So what we see is the environment itself was challenging during 2020 FY 2025. Um, the the like-for-like sales growth that we see means that um, the growth doesn't, the drop in price versus the growth of the business doesn't really make sense. This chart was very interesting that in the past 12 months, or in the year to April, the stores grew by 2.3%, whilst BRC sales, British Retail Consortium sales, dropped 0.1%. In the last period, so in the period from February to the start of May, the store's sales grew 6.9 versus 2.1. Every other store, like the average retailers, British Retail Consortium. So there's a triple performance in the fourth quarter. And remember, this carries on with 5.5 post, from May to July. So we see a tripling outperformance. We obviously don't know what the performance of BRC performance was post period, but we see an outperformance going on. And we also see, in terms of like for like sales growth, we'll come on to that in a second. But whilst it was a challenging market, that there was an outperformance as well. Now I'll come back to the drop here, this 12 minus 12 and the 0%. There are reasons for that, but um, we'll kind of cover those. I mean, sort of some of the reasons why, though, was, as I say, there was a fulfillment problem. So e-commerce delivery speed, promised next day delivery, and next day the things hadn't turned up, and a few days later they hadn't turned up, and then sort of unhappy customers. Minimum order size has been increased as well, so it's £3.99 postage below 30, free postage and packing above 30. So that minimum, or not, it's not a minimum order, but it's a minimum free P&P above 30. Let me just correct that. That again will have caused some reduction. So we see, if we map the like for like sales growth, so overall, obviously sales were down and then slightly up, and here, they were strong. So again, you might say, oh well, the reason that the like for like the reason the share price was double back then was they were growing at 10%, whereas today, well, the growth is moribund. Well, no, not really, because back here again, if you actually look at the stores, okay, look at the stores, and again, remember what I was saying about plus and minus 6 million. I mean, if you say, well, some of this 3.7 growth was revenge, and obviously these numbers here were just vast. This number here was substituting for this number here, and this number here was revenge of this number here. But also, people were used to buying online, so this number was small, was sort of partly offset that this 3.7 growth isn't necessarily reflective of the performance of 2022, and what we see is 7.5, 0.6, and then 2.3 growth in stores, and obviously 6.9 in the fourth quarter and 5.5 again is well ahead of, well ahead of 3.7, and a strong performance. Now I will address this as well, because online sales dropped 15, 12, 12. So on the face of it, you'd say, oh, get shot of it, get rid of it. But I don't agree, and I'll cover why in a moment. But what I want to do is look at like for like and non-like for like sales, because obviously these are the like for like sales, but then what we have is non-like for like. Now what I've had to do is go through, because you've got a sales disclosure, so the sales split was this and the sales were this, the revenue was this. Revenue and sales are not the same thing, the reason being that sales include VAT and revenue does not. So what I've had to do is make some assumptions that about 65% of what the sales were vatable. Obviously, books are non-vatable, as you probably know. So what I've done is I've split the VAT equally among the three different types of sale: the like-for-like sales, the non-like-for-like sales, and the online sales, to construct a split of revenue that agrees back to the revenue total for the 3 years, or sorry, for the 5 years. So what we see is, again, this is 2025 back to 2021, like for like store revenue uh, uh, actually grew, because yeah, so we've got sort of growing sales. So sales were actually about 25% higher, or 20% higher. But what I'd also call out is that the shops dropped from 527 shops down to 503. So that's about a 25% outperformance of 2022. We then have non-like-for-like store revenue. So you can see there's a large number in 2022, and a large number in 2024, smaller numbers in the other years. Online revenue, we can see online revenue is dropping. However, 25 million is 10%. That's a fair chunk of change, and we'll talk a little bit more on that in a moment. So the insights that I got from doing this analysis was to say, yeah, as I say, a 25% outperformance in 2025 per, in terms of store revenue, which, considering there's fewer stores as well, is impressive. Half the price, half the share price, but 25% more revenue. Okay. Um, I'd also call out the revenue per store. So this was the next thing that I looked at. But also I did two things. I looked at the revenue per store, but also looked at the non-like-for-like sales. Now, obviously, we don't know of these sales what the split were across opened stores, closed stores, relocated stores, and refurbed stores. They're all lumped together. But what we see is, when we look at revenue per non-like-for-like store, we see some very strong numbers back here. $1 million per non-like-for-like store. Well, that was the year that we did lots of relocations, a lot of refits. Same here, a lot of refits, and of course the refits that you do here would sort of, the benefit would come through in later years as well, not necessarily in the year that you do the refit, but in years afterwards. So what we also see is very, revenue per store in these years very low. But these were the years that we see a lot of closures, 24 closures, 13 closures, which is double the number of closures the year before. So whilst I can't pull out any specific numbers or insights, it feels to me that these numbers were a lot higher because they were opening stores, they were relocating stores and refitting stores that then had a very strong impact. But what we see here is that the new stores they're opening now are sort of, in the, obviously there's still quite a lot of closures, but the new stores that they're opening now are performing much better than 2023, 2024. The other insight was, again, the like for like. So there's the 25% outperformance, 0.4 to 0.5. That isn't immediately apparent. When you look at, oh, it grew 10.5% in 2022, and now the growth is only 0.8%. Well, that's true, but these stores are chucking off per store, chucking off 25% more performance than they did back then. So, a couple of ways of looking at it. When I looked at all of the 5 years and looked at all of the opening, closing, relocating, and refitting, I actually get to about 40% of stores, so 206 on 503 stores would be about 40% of stores have been altered, open, closed, relocated, refitted. Um, so to my mind, when you've done changes to 40% of your estate, you're moving the chess pieces around to kind of, again, to me, it feels a stronger business to have moved 40% of your stores around compared to 5 years ago. That to me feels like a big strategic difference that isn't in the numbers but will be in the numbers. Okay. And yeah, the store performance, as a result of changing 40%, we're seeing 25% more performance. So e-commerce, yes, the sales went down, have been going down for 3 years. It's also true that when you go through the annual reports, that 41 million visitors to the website dropped to 31 million visitors, so about a 25% drop on visitors as well. Couple of things, the business obviously made a mistake with their choice of fulfillment provider. They've changed that now. They've got a new provider. They've completely written off the e-commerce operation, so it's in the balance sheet at zero. Okay, it's in the balance sheet at zero. That's an important point. They've built or are building this year a new mezzanine, so it's basically an extra level in their distribution level. So rather than just having a ground floor with stuff going up, they've got two floors. Yeah, they've got they've doubled their space essentially. So that kind of helps with peak volumes because obviously this is a seasonal business when Christmas times and different times of the year, there's peaks and troughs of demand, of course. A new e-commerce fulfillment provider has been appointed. A new facility is going to be in operation before the peak period, so sometime in the next month or two. Given that the peak period still sort of starts around now, around September, so October to December is the peak period. It's expected to, the new service provider is expected to deliver cost savings and also a higher standard of service to customers. Okay, so comparing it to last year, the year before, it's a different ball game, different provider, different facilities, better facilities. They've invested into new software, so they've got a EPOS system that's connected back to the warehouse. So they've got click and collect now in operation as well, so they can fulfill orders to stores as well as send them by post directly to a customer. So they've got that. They're working on web analytics, so building out better visibility of people's movement through websites, to help improve their customer experience, and they're also doing sort of initiatives like when it's gone, which is kind of reminiscent of that middle aisle. And if you have a look at their website, I mean, I think personally, maybe I'm a bit biased, but it's nice and clean and crisp. Everything loads up. It's clear, kind of I if I was buying a Christmas hole punch, I don't think that's probably one that I would be bothered about buying. But if I did, it's got delivery, it's got reviews. I did notice there weren't many reviews. That's maybe a negative. But it's I think a good website, e-commerce website. I would shop there if I were buying stationery. Um, so when people say about closing it down, I think that'd be a massive mistake. Um, and there's a way to tell that it would be a massive mistake because what we're able. Oh, here comes the poltergeist again. Stop, poltergeist. Stop, stop, stop. Oh, come on, poltergeist, stop. Oh, stop. Oh, I do apologize for this. I don't know. I'm don't know what I do to wake up the poltergeist, and I don't know how to. I did find a way to stop him uh, in his tracks, but there we go. It seems like the only way to do it is you get to the end of the article, and then after a minute or so, it decides to come back from the dead. Um, oh, so I'm going to throw this across the room in a minute. Come on. Yes, there we go. Regain control. Where was I? Ghostbusters. That's what I need. Um, yeah. Sorry. Apologies. Yeah. E-commerce. Um, anyway, yeah, because you can work out you've got something called the online variable costs. What I've done here is I've taken the online sales, so the numbers you saw that were declining. I've taken the gross margin from all of the 5 years to then work out the online. Now, again, I'm sort of making the assumption that the retail shops margin and the online margin is the same margin. It's just same mix of products. We just don't know. Uh, maybe people buy books in the shop and don't buy them online, who knows? But anyway, I've kind of gone with an average. I've then deducted the online variable costs, and what emerges now, there's no disclosure in FY 2021, so there's no way of knowing what the profit was back then, but we see an outsized profit here, which of course was the revenge and catch up buying. But what we see is that profits from 2023, 2024, 2025, I mean, this is making 1 million a year as far as I can see. So given that the underlying profit or the statutory profit was 8 million, I mean, this is sort of 12% of profit then, isn't it? So closing it down, especially as they've put in a turnaround strategy, I think would be a massive mistake. The reason the sales are down is because they've put price increases, things like £4 postage if you're buying a below 30 quid. Um, I don't think the online performance is at all bad. Actually, I think, when you say, well, the operating profit has quadrupled from here to here, which it was more than quadrupled actually, that's actually a very good performance. I'm happy with that. If I had an online shop that had grown from 250,000 to 1 million profit in 2 years or 3 years, I'd be pretty happy with that personally. Um, so yeah, I think the success in online masks, that obviously there'd be costs of closing it down anyway if you did so. That yeah, there's every reason to feel pretty optimistic about and as I say, I mean, the website itself is a decent website. And if they're getting 31 million visitors to it, as they say they are, or they did, I think that there's every reason to feel optimistic that that can turn into sales. I mean, 31 million visitors, 25 million quid. So every visitor generates about 75p of no about 83p of revenue. Um, every um, every visitor. So if the operating profit is 1 million and 31 million visitors, I mean, every visitor to your website is generating you 3p of profit. If we can get 41 million visitors as they had the year before and the year before and the year before, that 3p of profit, I mean, your profits increased by a third. Just seems to me that it's actually a reason to feel very optimistic. Anyway, that's and I suppose it's just my opinion, but when I go on Amazon and it's sort of like it's just very busy, there's a lot going on. That one is kind of quite clean and crisp by comparison. So I don't know. I guess you can sort of look at it both ways. The Works have introduced EPOS, new EPOS. They've uh, they've told us that their cost efficiencies in FY26 are going to more than offset the 7.3. They say the increase of living wage and national insurance is going to be a 7.3% average increase. Basically, anybody who doesn't get the minimum wage increases is going to get 2% increase, including the board, which again I thought was a sign of a decent company, that they're not giving themselves vast rewards in return for so they're getting the same as everybody else, apart from those that get more because of minimum wage increases, which I thought was very fair. Coles Hill distribution centre has been restructured, new ways of working, new frameworks to improve buying, merchandising, new standards, what good looks like for stores, area managers driving consistency, leases being negotiated downwards, and closures have been driven by demanding cuts. So, give us a cheaper lease or we'll walk away. They've started walking away. They've closed stores, walking away to spook the landlords into giving them cheaper leases. They seem to be, they actually sort of go through with the threat. The landlord realizes it's not a bluff, so they'll sort of use that as a lever to negotiate better rates. They're also using a more scientific approach to kind of in stores use sales density measurements rather than just giving it to the discretion of the store manager to chuck stuff, pile it high wherever you want. That no, it's becoming a lot more scientific, pile it here and only here. So that's it's a difference from the past when branch managers just did what they thought was right. Like the one where I bought my Game of Thrones, decided to put it in the window, and it caught my eye, and I went in. It's kind of being more strategic about what's hot, what's not, and a branch manager that has never heard of Game of Thrones might not have put it in the window, and it was down to the one that I walked past that had and did that caused me to walk in the works. So they're also doing stuff, investing back into people, into leadership programs, into apprenticeships, flexible working. It's, as I say, emoticons, Gen Z, yeah. They're opening new stores in 2026. They are planning to do all of those levers to improve profits, improve store, improve in-store execution, a year-round proposition. So I suppose doing less, sort of sales promotions at Christmas and at certain times, but just sort of doing a year-round approach to sales. One of the other things I did, and I'm conscious that we're almost at time, was I worked through the cash flow. Now, when you look at the cash flow on the face of it, operating cash flow, it's generating 32 million a year, which of course is a nonsense, because if it were generating that amount of cash on a 26 million market cap, then again, its price to cash flow would be far in advance. What I've done is, rather than use non-cash adjustments, I've actually used the cash movements of the leases, because that's the number that's not in here in the accounts, because it comes under financing. So what I've done is I've taken the numbers payment of lease, capital and interest as the cash movement to kind of give myself an operating cash flow. So again, what we see is operating cash flow, to be fair, was strong back here, 12 million, 11 million. What we see is obviously operating cash flow falls quite dramatically here and here, but we see a rebound in FY25. And again, what I have done is basically take that number, the 24.4 million, divided it by the number of stores to work out that, back here, leases were costing the works 58,000 per store, 58,100 per store per year on average, with 525 stores. Today, that lease bill has gone down by 6 million, over 6 million. The cost per store has dropped by, again, by sort of nearly 20%, 17%, something like that. So this operating cash flow Okay, yes, it's lower than FY22, um, but a lot of the difference there is just down to margin. If they can get their margin back to the 61% it was here, which is a 2%, which is their strategic plan anyway, then what we would see is a rebound in profit. So yeah, again, that felt, looking at it from a cash point of view, it's generating real cash. It's generating 7 million, which is 3.66 times its market price. So every year, every pound that goes in the till equals to 27. Oh, there goes the poltergeist again. We're almost at the end of the article, so it's not going to poltergeist for very long. But yeah, you can sort of see anyway to conclude that when I looked at this, the only thing I'm going to just kind of, once this allows me to regain control, do apologise for the poltergeist. I will. Oh, there we go. What I will do is just quickly mention. Yes, that's the cash. There's obviously a number of new leadership positions, so I cover those here. To be fair, I've followed what Mr. Rebel said about this and taken his input really more than anything else. But yeah, certainly they are all credible leaders, and they are new into the business around the existing CEO. So again, I see that as a positive. What I've done for my forecast for FY26 is that we've seen store growth of 6.9. We've seen 5.5 post period for the first 11 weeks. I'm going to assume a further slowdown to 5%. I'm going to say that the 5 new stores they're planning, that they don't generate any extra revenue. Rather than minus 10%, due to positive FX rates, I'm going to assume that cost of sale actually goes up, and obviously cost of sale going down because of lease costs going down. I'm going to assume they go up, okay, up only by 3.4, but they're going to go up, okay. I'm also going to assume that there's a 2 million admin cost from those living wages, and okay, yes, there are cost savings, but there's still a 2 million increase in costs. This is what we see happen. So there's my 2 million of increase of costs. There's my 3.4% increase of cost of sale. There's my 5% increase of revenue. So we see gross profit increase. We see operating profit increase. And then down here, we see net profit increase. And I'm just assuming finance expense stays static. Part of this finance expense, of course, is the leases that are going down. So there's every reason to think that that could actually be lower. But even if we just say, even with some fairly conservative assumptions, and I think this FY2026 forecast isn't a particularly aggressive one. If anything, that's on the low side. We see a profit equal or near to the profit in FY 2022 when the share was double today's price. So I think the fact that I kind of missed that 5-year little piece was not a good thing, but hasn't really mattered because this 12.3 statutory profit, if that's what the outcome is, would put it at 2.2 times earnings, which that's a very cheap price. That's kind of about 45p earnings per pound going in the till. So misreading could have cost me, but now I've deep dived, I realise it doesn't and it won't. Obviously when you do back of the fag packet calculations, there's dangers to that. So deep diving, as I've done in this article, is the right approach to take to invest into a share, not to just it's that DYOR, do your own research. But the fact that sales in FY26 are going to be 290 million, not 375, that we're not going to see a 12 million reduction of cost of sales, we're not going to see a margin increase above 7%. This margin here is, as you can see there, that's or sorry, that would be the gross profit, not the EBITDA. But we're not going to see a gross profit, sorry, an EBITDA of 7%. Even though we're not going to see all of this, we're going to see plenty, in my opinion, that as far as I'm concerned, it's intrinsically misvalued, even in FY26, and even after these rises in price from where it stood at the start of 2025. I sort of said in my Fun Run article, I wish I'd spotted this a year ago or 8 months ago. That when you actually look at the performance, I mean, it's entirely um, conceivable that this would have increased in share price, would have tripled, and so it did. Obviously, it's come back off the boil now. I suppose people are profit taking or whatever's causing this to go down, and also there's just that general malaise and sense of, oh, Britain is doomed. Well, go to the high street, because when you do, there's still plenty of people shopping. There's still plenty of activity. The tills are ringing. The evidence to the middle of July is that the tills are ringing 5.5% faster than they did the year before. Like for like sales are up 5.5. Like, don't get caught up in the doom and gloom of, the newspapers that will sort of always talk a negative story, because you've got to look at the analytics of what the actual story is. And anyway, none of this is advice, but hopefully this has been a useful deep dive into the works. As I say, this will be published in due course in the next days. And this is the Oak Bloke signing off. Cheerio for now. Cheerio.